Hello everyone, and the headline looked good, but it's not a great day in Asia actually on the economic data front. GDP for China did surprise, especially me, up 3.9% in the latest quarter. The problem with that is with the previous quarter's 2.5% decline thereabouts, we're up about 1.3% in economic growth over a whole half-year period. Now, of course, this is an artificial number, really. It's not an indication of the underlying strength of the Chinese economy. It's the underlying strength of the economy combined with COVID restrictions. Now, why that's an ongoing concern is at the Party Congress, it's become quite clear that China will maintain its zero COVID approach. So any future outbreaks of COVID will again see severe lockdowns implemented. So I think the outbreaks of COVID are going to become less and less, but China not having experienced it in the way that many of the other countries around the world have probably means there are going to be ongoing outbreaks from time to time. So that is a concern. Overall, the Chinese economy has grown 3% so far this year, so well below the target of 5.5, but again, that's to be expected with the COVID lockdowns. My point remains, and it's not a point a lot of commentators and economists are making, is that China has permanently reset itself to a 2 to 5% range, which is below the current target range, as part of the overall maturing of the Chinese economy in a historical context. Some of the other economic data out today in China was new home prices falling again. I think that's for the fifth month in a row. That's the biggest decline in 7 years. We know there is a bit of a property bubble in China. Plus, again, the COVID lockdowns would not have helped buying sentiment. We also saw a reasonable industrial production number, around 5.9, I think it was, but that's well down on what we were used to pre-COVID and not a healthy number. Unemployment rose slightly, again, not great. Retail sales, though, was the real shocker. It really fell sharply, and retail sales remained very weak across China. So economic data in general, industrial production, reasonable, but industrial production utilization was just 75.6%. So that's a very low number for a utilization rate for any major industrial power. Again, it's the impact of COVID, but also that's masking this long-term underlying historic economic slowing that is just a natural byproduct of an economy having gone from really agrarian to a consumer-based society and highly industrialized over the last 2 or so decades. But that rapid growth, capitalism by its nature needs to expand to be healthy. And so that rapid growth throughout the China nation is nearing maturity. So that means more difficult GDP and economic growth numbers ahead in the long-term context for China. Over in Japan, we saw manufacturing data there hit a 21-month low. Not very nice. And down under in Australia, we actually saw the S&P, so it's not the official really, but it's the S&P Global PMI for services in Australia actually went into contraction. Now, I've been warning for a long time that Australia is headed for a surprise recession, and that data really does reinforce that view that I have. So 2023 could easily see a recession in Australia. Manufacturing hit a 14-month low. The S&P Global Australian PMI hit a 14-month low for manufacturing today, went into contraction for services. An economy in trouble, whilst the RBA governor continues to raise interest rates, albeit at slightly smaller components, but still raising interest rates. And we saw some ridiculous comments from the RBA today, the RBA's Kent today, about, yes, we have to raise rates to hurt consumers need to know that we want them to slow their spending. I mean, the absurd self-importance of these people at this little bank in Martin Place, when they pretty much get every forecast wrong, but still thinks for some reason the Australian public should listen to what they want them to do. It's very odd behaviour. There's very much a Peter principle at play within that organisation. And as you know, for some time I've been advocating a review, which the current government is now doing. So has the OECD advocated a very serious and urgent review of the RBA, and we must continue to push that. It requires a revolution, not just a review. A very internationally embarrassing little bank indeed. Market reactions to all this economic data on the day has been muted. It could have been a little bit more euphoric on the headline number from China of 3.9%, but really the reaction has been muted because there's a whole lot of other data in the mix there that isn't so healthy looking, and certainly that number didn't do much in terms of the last 6 months of what's been going on in China, just 1.3% GDP growth. I think moving forward, the Australian dollar rally, if we see one on this data, could be muted and begin to roll over. I still think the US dollar could have further upside. I still think sterling has further downside because people are appreciating that Boris Johnson withdrew from the race for Prime Minister there. But really, are any of the other candidates going to solve the problems of the UK? No. Why? Because they're probably implacable problems to solve at this point. So the UK, recession, ongoing troubles, I really don't see a great reason to be buying pound, except if the Bank of England was silly enough to, on top of all this, further harm consumers. And we know consumer sentiment in the UK is at all-time lows, most depressed the UK has ever been, and that's really saying something. If the Bank of England continues to hike rates, it's just going to be a real disaster there economically. So I'm still very bearish for the pound. Clifford Bennett, Chief Economist, ACY Securities. Thank you very much.